Ford reports strong Q1 profits amidst sales slump, and Tariff Windfalls. Ford Motor Company has reported a resilient first quarter, characterized by a significant rise in revenue and net income despite a notable decline in domestic vehicle sales. While the financial results appear robust on the surface, they are heavily influenced by a massive one-time tax benefit and ongoing logistical challenges in its core segments. Financial performance at a glance, despite an 8.8% drop in U.S. sales totaling 457,315 units, Ford managed to grow its quarterly revenue by 6%, reaching $43.3 billion. This top-line growth translated into a net income of $2.5 billion and an adjusted EBIT, earnings before interest and taxes, of $3.5 billion. A critical factor in these figures is a $1.3 billion one-time IEEPA tariff benefit. In practical terms, this windfall serves as a financial offset for the costs previously incurred due to trade tariffs. While this bolsters the current bottom line, it is a non-recurring event that masks the underlying pressure tariffs have placed on the company's cost structure. The Great Divide, gas versus electric. Ford's performance highlights a widening gap between its traditional internal combustion engine ICE business and its electric vehicle EV ambitions. Ford Blue ICE vehicles. This division remains the company's primary profit engine, generating over $1.9 billion. Success was driven by gas and diesel-powered models like the Bronco, Explorer, and Expedition. However, even this powerhouse faced headwinds. F-Series truck sales fell by 16%, a decline attributed to supply chain disruptions following fires at an aluminum supplier. Ford Model E electric vehicles. While still heavily loss-making, the EV division is showing signs of narrowing its deficit. Losses for the quarter stood at $777 million, an improvement from the $849 million lost in the previous quarter. This trend reflects a broader industry struggle. Automakers are using the high margins from traditional trucks to subsidize the massive research and development costs required to transition to an electric future. Outlook and economic headwinds. Looking ahead, Ford has expressed confidence by raising its 2026 outlook. The company now expects an adjusted EBIT between $8.5 billion and $10.5 billion, up from its previous guidance. This optimism is backed by a massive $22 billion cash reserve, which allows the company to reward shareholders with a 15-cent dividend this June. However, Ford's leadership remains cautious about external volatility. The company noted that its guidance does not account for two major black swan risks: geopolitical instability, continued conflict in the Middle East, and potential disruptions in the Strait of Hormuz. Macroeconomic shifts, a potential downturn in the U.S. economy, and rising fuel costs. Ford is currently navigating a delicate balancing act, leveraging the massive profits from its legacy gas-powered fleet to fund a costly, high-stakes pivot toward electrification, all while managing significant geopolitical and supply chain risks. Conclusion: Ford's strong Q1 results demonstrate the company's ability to maintain profitability through its traditional vehicle lines and unexpected tariff offsets, even as it faces declining sales and the heavy costs of its EV transition. The company's future stability now depends on its ability to manage global economic volatility while scaling its electric division more efficiently.